Mike Wilson of Morgan Stanley seeing better balance for next year, saying we see more balanced EPS growth in 25 for the S&P 500. This should lead to better breadth, something that has been absent over the last 2 years. And Mike Wilson absent over the last few weeks. Good morning. What's happening?
Well, this is the debate, right? So I think what's happened is we got the broadening out in the fall on three things. A, we priced out the recession risk, which was kind of creeping into markets. The Fed went 50, which, was a surprise and maybe not even necessary. And so that got people juiced up. And then, of course, we had the election. And I would say the election was positive for two reasons. We talked about this last time. One, we got a Republican sweep, which markets tend to view more positively. But more importantly, it was definitive. And so a lot of those hedges came off. And those hedges were in some of the lower quality areas. And so I think that kind of basically pulled forward the initial move on the broadening out. And now what's happening is because rates are back up, there's some concern about the Fed not being able to cut perhaps as much as people thought. And so we're seeing a de-risking kind of into year end, or just some profit taking, quite frankly. So we'll see. I mean, look, when you read the note, but I mean, we said we think there's a broadening out. That's not what we think. That's what the consensus thinks. Okay, so in other words, that's the expectation. If the consensus numbers are hit next year, bottoms up, we will see a broadening out. That's the key. It's about earnings revisions. And we're just being a little more selective on that. So we upgraded, financials. We've been more constructive on software, some of the industrial names because of the earnings story. And that's how we're going to trade this for the next 3 to 6 months, is we're going to look for the areas where revision breadth is improving. It's not going to be universal. This is not like coming out of a new cycle. So I want to make that perfectly clear to listeners that we're not expecting a broad rally in the way like 2020, 2021, where the low quality stuff, everything goes up. It's going to be more rifle shotted to the areas where growth is improving.
Let's sit on that distinction. It's not a new cycle, it's a late cycle extension. That's what you're calling it.
That's right.
Why is that so important? What's the difference between the two?
Well, we're getting what we usually get. We called it classic late cycle back in 2017. It's actually the most bullish part of the cycle because the Fed is moving, multiples expand. So let's just talk about what happened over the last 12 months. That's exactly what's happened. Earnings estimates have not gone up for 25 and 26. They've just rolled forward. Multiple went from 17 times to 22 times. That's very typical in the late cycle period. You typically get narrowness, which is what we're getting right now. The quality stocks have continued to work with this back and forth, this uncertainty around, is it a hard landing? Is it going to be a reacceleration of growth? Is the Fed doing enough? Are they behind the curve? Are they ahead of the curve? And that creates these really opportunistic rotations.
How much is this late cycle trend turbocharged by the idea that there is no alternative than the United States right now?
Well, that's a very good point, Lisa. I mean, we wrote about that in our last note about a month ago, or that monthly note that we put out, just saying, we were in Singapore talking to investors all over the world. There's just no interest for anything except the U.S., this U.S. exceptionalism idea. I think Trump winning just makes people, it's like a magnet because it's like, they're just going to put all their resources now internally. And so that helped. And I think that's price. That's what the markets are saying. Okay, the markets are basically saying that's correct. Now, is it overpriced? Potentially. I mean, clearly in some stocks and sectors it's overpriced, but that move is not wrong. I think the markets, I think investors are just seeing what's right in front of them. They're saying that America is going to take share. America has this America First agenda.
When you talk about a sort of a rifle shot, you have to look at the areas of growth, and you've talked about the rotation in themes and that this is a market searching for a new theme other than AI. And I'm just wondering what's on your bingo card in terms of the theme that's going to pop up next that could be really transformative for investing trends.
Exactly. And so we're trying to find areas that have not yet recovered from what I would say we've been in a 2 to 3 year recession now. In the private economy, we've been in a recession in housing, manufacturing, IT spending away from consumer goods. So there's been a lot of things that have been beaten up. So we're looking for the next thing where there could be a reacceleration. Two areas that look interesting. We're not there yet. Consumer goods, where inflation actually maybe is picking up now, which is actually good for earnings. And the second one's transports, which have been in a depression because there's been no restocking. There's been no kind of pull forward. And so if animal spirits come back, those are two areas where we think there could be life. Now, like I said, we're not there yet because we haven't seen a revision breadth bottom out, but those are on our bingo card.
But on the flip side, what is potentially others you can see in this move into maybe depression mode?
Well, I don't think there's a depression. I think, but there are areas that are probably going to see a deceleration. So, for example, semiconductors have been trading terribly, mostly because they're in a deceleration now, except for a handful of stocks really benefiting from AI. I mean, if you mention AI, you benefited, but the reality is it's a handful of stocks that have actually seen that spending increase. And the traditional semiconductors actually got bid up on that idea, now are selling off in memory and analog, some of the more commodity areas. So that's actually happening right now. I think we're going to see some of that maybe in consumer services, where we're seeing a deceleration in inflation. Now, a little adage that I think people don't appreciate is, average stocks do better when inflation's accelerating, right? Because that's their pricing power, that's earnings growth, that's 2020, 2021. And we've seen this divergence between consumer goods and consumer services, where services have had pricing, goods have not. And now, if you look at some of the data in the CPI, which I know you follow closely, we're seeing services decelerate and goods are actually starting to bottom out. They're still negative, still seeing deflation, but that's starting to turn up.
When it comes to the most bullish catalyst for next year, the Bank of America Fund survey talked about China, reacceleration, AI productivity gains, a peace deal in Ukraine, and U.S. tax cuts. What do you think would be the most bullish?
Well, I think U.S. tax cuts are kind of off the table in terms of incremental. Now, I could see an extension of what we've gotten, and that's sort of just, I don't think that's an incremental positive like it was in 2017. So I take that one off.
Status quo.
Yeah, I mean, if they don't extend it, then it's a real negative. I think that's the way I think about taxes. I would say on the peace deal, I mean, that's, okay, I mean, yeah, we're all hoping for that, but I'm not sure there's an investment opportunity in that. I mean, like a lot of people are bullish on defense stocks, so maybe that actually peels off. So that could be somewhat of a negative for certain areas. I would say that, the productivity thing on not only AI, but productivity in general. I mean, are we going to get more productivity out of people? Because, we're not allowing as many immigrants in anymore. We need to find labor productivity. If we don't get labor productivity, that's going to be a real headwind for businesses. So I think that's a big one. Some of it's AI related. Some of it's just getting people more efficient. Look, people are still getting back to work in the office place, quite frankly. You know what I mean? I mean, the one that I would put on
federal government.
Yeah, when I would put on the card, and this is more of a 26, 27 story. Can we get more efficiency out of the government employees who are not bad workers or bad people? They're just maybe playing for a bad team. We talked about this last time. Can we get those people repositioned in the private economy as the private economy now is starting to recover?
You said something that I want to pick up on, that companies tend to do better when inflation is accelerating. And this kind of flies in the face of what a lot of people are expecting for next year, that the disinflationary environment is going to be a Goldilocks nirvana for equity valuations. Right. How much is, if the Fed gets what they want, and if we actually do see disinflation, that could be one of the bigger risk cases to equities that have benefited from an acceleration in inflation that has given them pricing power? Totally. Multiple will come down. Okay, so I think this is an index risk, and I've been thinking about this for a while. So we had this rally in from the summer where the average stock did better, right? Look at, just say S&P equal weight versus market cap, and that was a pretty powerful rally. It's giving up almost all those gains now, and it looks to me like we're going to make a new low in that ratio. Like we're going to retest the lows in the first quarter, meaning index market cap is better than equal weight, and that's the low that I want to buy. Now that could mean that maybe inflation is stickier, that pricing is better, earnings end up being broader, okay? And you see a rotation where the average stock does better than the index. Now that could also mean an index level correction of 10% plus, but that the average stock does better. Same thing, by the way, happened in early 2000. So it's a very similar setup where 2000 was a great year for the economy, okay, but the index came down because the high flyers came down as rates went up, and the average stock actually did quite well. So that's an interesting kind of thing that we're looking at. I think it's too early to do it now before year end, because this is kind of monkey time for the last 2 weeks of the year. I mean, people are just,
What's monkey time, Mike?
Monkey time
is basically monkey time.
Yeah, I mean, we're
sort of like
marking up positions, like it's just everybody wants to get to the holiday. I mean, so no one's really taking big bets right now. That's my point. And I think the first quarter could be interesting in this regard.
Correction in Nvidia. We're down by a little more than 10% off the highs in November. What do you think is going on there?
Well, I mean, there's a deceleration going on, right? I mean, gross margins peaked earlier this year. We're seeing a deceleration in growth, still very robust, okay? This is not like a situation where they have a problem. It's more of just that, hey, this thing priced a lot of good news. It's kind of gone sideways since the summer. It's digesting that. We're seeing a rotation into some other AI winners. That money's moving. That's normal. I don't think there's anything nefarious with that.